Delinquencies are on the rise. People can't pay their bills. People are in forbearance. They don't have a job, reduced hours, temporary employment. The situation reversed somewhat, but in many areas it went back to a downward trend. This is not good considering the amount of stimulus already provided to the system from all angles. Imagine how much adrenaline has been pumped in as it fades away into the darkness. Instead of fixing the issues while they had a chance, they simply opted to wait it out, and now here we are. You came here for the truth, so let me unveil that for you. Today we are going to look at what's happening with delinquencies, what's happening with people and their inability to pay their bills, and of course the economic factors that are all surrounding this. I've got a very interesting video to get into. First I want to begin with the delinquencies, then I want to cover what's happening with the debt, the job situation, and so much more. So let's begin. This comes out of Core Logic. I've shown you data here before. This one really highlights what we are seeing, particularly with the delinquencies. But as we piece all of the information together, it starts to really paint an interesting picture. Jump in early stage delinquencies, that is basically 30 days, leads to the highest overall delinquency rate in over 4 years. This is going to make a lot more sense when you not just look at this, but you see it month after month after month. We are looking at April's data right now. So when we get May's and when we get June's and when we get July's, we're going to see that trend. Right now, the trend is increasing, but we'll see where it goes from here. The nation's overall delinquency rate was 6.1% in April, while all states showed increases in the overall delinquency rates. Those increases were highest in New York, New Jersey, Florida, and Nevada. I want to know where this is going to all end up because right now you have these forbearance plans. You've got people that do not have to pay different types of bills because of what the government has done. I'm sure they will extend that out further and further as long as they can, but that puts additional pressure on the landlords, the lenders, and so on. We've talked about this many times before. Think about it. If you're a landlord, you're probably running pretty thin on your margins as well. If you're the lender, there's only so much time you're able to let them not pay up because that hurts your bottom line too. All of this is really interconnected, so you can't see it as just one point. You can't say, well, don't let them pay for a while. It's fine. The banks make a lot of money. Well, it doesn't really work like that on the short term, of course, and even the medium term. It really has an impact on the jobs that are there. It really has an impact on the economy as well. I've covered that. I'm not going to rant on about it. Further down in the report, in April 2020, 6.1% of home mortgages were in some stage of delinquency, 30 days or more past due, including those in foreclosure, as the overall highest delinquency rate since January 2016. So April's delinquency was a 2.5 percentage point jump from the prior month. So if we continue to see that trend, obviously that is quite worrisome. People need to understand that when you see these types of jumps coming month after month, you might say, well, it's still only 6%, but that is significantly higher than where they would love it to be. Just like with there's so much leverage being used in the system, and of course, when you have just a small percentage not paying up, it really has an impact on everything connected with it. There are two charts I want to show you here. Percentage of mortgages at least 30 days past due for the 10 largest metropolitan areas. And you can see on the top of the list, Miami, then we have New York, Vegas, Houston, and it goes down the list. States with the highest and the lowest rate of mortgages at least 30 days past due. New York is on the top. And if we go to the very bottom of the list, you have South Dakota, Idaho, Wisconsin, and so on. This Wall Street Journal article gets into the issue of people being unable to pay their rent, unable to pay their mortgage, their debt, and so on. It does cover a lot of issues, but I just want to touch on a couple points. Millions of Americans who have missed rent payments could be at risk of being evicted in the coming months unless government measures to protect them are extended. Nearly 12 million adults live in households that missed their last rent payment, and 23 million have little or no confidence in their ability to make the next one. That is huge. You've got a problem today, but the problem down the road extends even further and it spreads even further. You've got a lot of issues here that are certainly happening that are not being discussed because the data that we have, we're looking at last month and the month before. And in the case of the delinquencies, that's April's data. What's going on with May and June and July? We will certainly find out in time, but for many cases here, it's not looking good. It's important to note that about a third of the country's renters are protected by an eviction moratorium that covers properties with federally insured mortgages, but that expires on July 25th. They will probably extend this. I think that is likely, maybe not for all of the places. I don't know how they're going to work this out, but they know that the economy has not rebounded. They know that everything that they said would happen never did, so they'll probably have to get some stimulus ready. There'll be a last minute bill that gets pushed through. It's got all kinds of nonsense in it. Who knows what's going to be there? It'll be 10,000 pages. They'll have 10 minutes to sign it, and who knows what it's going to really encompass. But I'm sure part of that will be to extend this. They'll give some stimulus. They'll give people checks, and everyone's happy. Weekly jobless claims rise by more than 1 million for the 17th straight week. They were supposed to have a V-shaped recovery. It was supposed to rocket back. Everything was supposed to be fine by now, but we know that that's not the case. Initial weekly jobless claims came in at 1.3 million for the week ending July 11th. I've got charts to show you, of course, that connect in with this. I've been doing weekly updates on this, so I just wanted to bring that to you and show you exactly what's been going on. Here you can see the initial claims for unemployment insurance, and this just gives you an idea, and it really zooms in to show you specifically as we had seen the peak and the decline afterwards, and it starts to kind of flatten out right about now. We've been seeing it above that 1 million. Nobody really knows what's going to happen here. There are people going back to work in many areas, but as I mentioned earlier, some of them have started to reverse. We'll see what happens when we look at industrial production, for instance. That has been increasing. I've made that very clear. We have seen that. The numbers are there, but it depends on what's been happening at a deeper level. How many people will not get their job back? How many people work in industries that are being completely decimated and will not return, at least for the foreseeable future? That, I think, is the big story that you're not going to get by looking at initial jobless claims. Continuing claims for unemployment insurance, 17.3 million. This is really excessive when you look at it, not just compared to what we saw leading up to this, but the total amount of people here that do not have work is truly excessive. Over 50 million people had their job taken away in the last 17 weeks, all right? The amount of jobs that were created since 2010, it looks like 22 million. So clearly there have been so many people impacted by this. And what do? They send people $1,200 paycheck. That's not going to fix the problem. If you give people $1,200 here, $1,200 there, if you prevent them from getting evicted, that does not solve the issue. They never get to the root cause of the problem, and of course these things come up every so often. It tends to affect the people in the bottom 50% of incomes, but still, this issue is going to present itself not just now, but for forevermore. U.S. job gains look like they're slowing or reversing in July. U.S. job gains are set to slow sharply or even reverse in July after a new wave of shutdowns stymied the economic rebound. This is what I was talking about here. I wanted to show you it from Bloomberg. They have some data surrounding that. I'm sure you've been seeing this in the news. Let me just point this one thing out here. California on Monday ordered all inside dining and other indoor entertainment closed while shutting down business more broadly in harder hit counties. Washington paused any relaxation of restrictions in the state for 2 weeks, and apparently job openings across the U.S. had dropped 5.8% 2.5% over the past 2 weeks, with declines in all 50 states. This is really key information right here that I just brought to you, and we could see that this is brought to us from all different areas. We're not just looking at the initial claims. We're not just taking anybody's advice. We're pulling the data from all these different places. I hope you do appreciate that. I'm trying to do my best to get all these different sources, bringing them together. And remember, the source is not Bloomberg. I'm reading a Bloomberg article, but they're pulling this information, for example, in this case, Glassdoor. It's just like when you look at OpenTable and Yelp and all these different, what I call second and third tier sources of information, second and third tier indicators, those really paint an interesting picture as far as I'm concerned. They say that money makes the world go round. Well, really today, it's debt. 30-year mortgage rate reaches lowest level ever, 2.98%. I just did the video, what was it, yesterday, the day before, showing you it was something like 3.15%, somewhere in that range. It's already below 3%. I'm outdated already. The mortgage rates are declining so rapidly. In Canada, they're even lower. In other places, they're even lower. But if you see what's going on in the US, 3%. It's unbelievable to see this. And of course, this is going to have an impact on real estate. This is what they're trying to do to ensure that people continue to buy, they continue to borrow, they'll refinance their mortgage here, try to save a little bit of money. Ultimately, they're trying to keep the bubble expanding forever. Half of older millennial renters have reconsidered buying a home in 2020. Here are the numbers here. It doesn't matter where you look, but essentially, I do believe that there has been an increase in the amount of people thinking, you know what, maybe now is not the best time. So this can continue for a while. But if you see many cities, I know that there will be comments here that suggest many people are noticing still a lot of for sale signs. There's still a lot of people that are buying homes, they're selling homes, they're actively doing business as usual. But if we see the trends, it's really not the case. All right, here's the last one I wanted to cover. This is from a Twitter account that's showing you some of the details of what's happening in the car industry. I've been focusing on this because it not only tells you about what's happening in this one sector, but we can go in and look at how many different things it opens up about, because it's not just the jobs, but it tells us about what's happening with the industries that are impacted by it. Which cars are being purchased, which cars aren't being purchased, how many are being made, how many are sitting at sea, you remember that one, how many are in the parking lots. If delivery trucks are being purchased, that's a sign that we have things being bought and needed to ship, and so on. There's a lot of different levels to that, of course, but if you look at what's going on here, it is quite interesting. Drove past the WPB airport yesterday and saw this, a death yard for rental cars needing maintenance and out of commission. Every car mechanical issue marked on the window. There's more detail there if you want to read it up, but basically you could see all the different pictures on the right hand side. You can click them, open them up, it'll bring you into a new thread. But all I just want to show you is simply that there's these lots, these massive lots, whether it's for Hertz, whether it's for any of these other companies, that they have piles and piles and piles of cars just sitting there. They haven't been written off yet. They don't even know how many are really affected by this. When you go into more depth with it, I'm sure we're going to be seeing this in more detail. There's no doubt about it. This is one particular company that has clearly been affected, but I know the auto industry as a whole is in a very bad position. I'm going to end the video there. If you found that informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. All you got to do is click that one button to help me out. Thank you. If you want to check me out on Instagram and Twitter, you can do so at The Money GPS. If you want to learn how to sell stuff online, I've got a free e-course for you to check out. It is available at the AmazonGPS.com. My 2 books have everything you need to explain the financial system, to ask the right questions, to know what's really happening. If you want to flip through them for yourself, you can do so at the link in the description. If you want the audiobook, themoneygps.com. Wait a second, don't go anywhere. You've got to watch this video. A lot of detail in here. It will explain to you what's happening on so many fronts. Click it. I'll see you there.